All right, so in this part 2 of group consolidation, we are going to look at the 2 extra workings that you need to do, which is on the exchange rates. Then we pick up a question that we do. Unfortunately, the internet had messed up and the line cut, so I had to redo this part 2. So now we are going to look at the workings. So our working 6 will be on exchange differences. And the exchange differences, what we are looking at is the exchange differences that is coming from the goodwill side and also from the net assets and the profit side. All right. So I'm going to give you the format to that. Then we'll put it down. We'll learn it to it. We'll also learn the disposal side and we'll pick up a question and we'll go through it. All right. So let's go into it. So what we're going to do is that we're going to do this working 6. We have the A, working 6A, which is goodwill translation. All right. So I told you why there is exchange gain or loss on goodwill coming from the goodwill translation. So this is what you do. Let's say our foreign subsidiary is in dollar. Okay. So our example is based on the fact that our foreign subsidiary functional currency is in dollar. So like this. All right, so this is what we are going to do, and we need to bring it into CDs of parent. All right, so that is what we are going to do. So you put in your currency. All right, or let's say rather they are into CDs and we need to push it into kind of dollar. All right, so let's make it like that. Whichever way it is, all right, you have to put in the currency of the sub, then you do the exchange rate. So let's say we are converting, rather this one is in CDs and we are converting rather into dollar. All right. So we will work our goodwill. So our opening goodwill, we will work it. And where do we find that? It's our workings 3. So goodwill at acquisition. That is your opening goodwill. So at acquisition. All right. You know how to do that. So you slot it in. Then you will use the opening rate, okay, to do the conversion. The opening rate, you use the opening rate to do the conversion. I'll come and talk about that opening rate very soon, because what happens inside the opening rate, let me just give you a gist. So this one, let me just say that if the sub was purchased media, then your opening goodwill, take note of that. All right, your opening goodwill will be called goodwill at acquisition. So goodwill will be goodwill at acquisition, and that you have to now bring in the spot rate. You will use the spot rate. So this one becomes the spot rate. All right. So instead of what? The average rate. Please take note of that. If it is acquired media, then it means that you need to use the average rate. The spot rate. All right. So take note of that. The opening goodwill will be called goodwill at acquisition. And that means that you are going to apply the spot rate, all right, instead of the average rate. Take note of that. It's very, very, very important. Very important. So that said, let's continue our working. So that is for the opening rate, all right. Then Normally, what do? You bring in impairment, right? Impairment loss. You deduct. Then you will use the average rate to impair it also over here. All right. Then you realize that your goodwill at end will be discovered. So you will have your goodwill, closing goodwill. That is what will happen. Because there is going to be an exchange gain or loss here. But the exchange gain, so exchange gain or loss, it won't be here. But it will be the difference, because this closing good will also be translated using what rate? Yes, your guess is as good as mine, the closing rate. So you will see that there is a figure that is not balancing over here, and that will be the exchange gain or loss. So that one is here. Exchange gain or loss. So that is the workings you need to do. Exchange gain or loss is the figure that you will find here. All right. So goodwill that you calculated there at acquisition 1, you will use the opening rate, but the opening rate, so opening rate or average rate, but that rate, if the thing is bought media, then focus on your, what do you call it, your spot rates. All right. Now, what I need to tell you is that this one that you have found, all right, what I need to tell you is that if the fair value method was used in valuing your, the full goodwill method is used in valuing this. So if fair value method was used, because when you are doing goodwill, remember you do the NCI part, right, at acquisition. So if or full goodwill, you know that fair value method is called full goodwill. Method is used. So if the fair value method or the full goodwill method has been used, then we all know that you share stuff, right? Like the impairment and things you share, right? So if this one has been used, then what you are going to do is that this gain or loss, the gain or loss will be shared between the CI and the NCI. So using their respective percentages. But if the proportionate method was used, so in the very introductory videos on console, if proportionate method is used, then it means everything is for the group. So it means that for this one, it will only be attributed, the exchange gain or loss will only be attributed to who? The group, which is the CI. All right, so that is that. Your workings B, quickly, your workings B also is on the profit and the opening net assets. So opening net assets and profit, you do it together. So that one too, you have your CD sign, you have your dollar sign, in between is the exchange rate. All right, then you have the opening net assets. All right, so you have that and you slot it here. You use the opening rates. Don't forget, if the sub is purchased media, then what is going to happen? The opening assets, I'll come back to that. The opening asset is the acquisition net asset, and you have to use the opening rate, which is the acquisition rate, i.e. the spot rate, if it is bought media. So just as I did in the other side. Okay, so you use the opening rate, you use it to translate. But like I said, if sub is purchased, mid-year. What is going to happen is that this opening rate will be what? Your acquisition rate, which is your spot rate. All right, take note of that. All right, so that is very, very important. But somebody will ask, what is the opening net asset? Opening net asset, to, like I said, if these things are bought mid-year, what is going to happen is that this one, all right, is the same acquisition net asset. Net asset at acquisition. So that is what we are referring to. Then what else do? You bring in your profit or loss for the year. For the year. So that one too, it can be profit, it can be loss. All right. Translate that. We said profit items are translated using which rate? Average rate. So translate that using your average rate. So you put it in here. Then you find your closing figures. So my closing figures. So closing net asset at reporting, right? Closing net asset, that's the one at reporting, should be here. Now you do the exchange rate using what? Closing rate. Using your closing rate, you realize that the 10 will not be balancing. There will be something here. So that will be your exchange gain or loss. And again, this exchange gain or loss, like we said, is the exchange gain or loss on what? Exchange gain or loss on opening net assets and also on profits. So you split it between what? The group, which is the CI, and also what? The NCI, based on their percentages. All right, so that is that. Okay, so that is that. Now, these things that we have done, the exchange rate on goodwill and that of the net asset. So all that, the exchange differences that we have done, please, it doesn't go to retain earnings. Take note of that. The exchange differences, because it's not realized yet. Exchange differences that you have, I mean, the one on the goodwill, which you may share or may not share, then the one on the net assets and the profits, all right, which of course you will share. All these things go into another line, which we call translated reserve. Translated reserve. That is the name. And that will be part of, it will be under the equity side of your SoFP. All right. So you don't add it to retain earnings. No, you don't do that. All right. It will go to the group translated reserve. All right. So this is it. This is all you need to know. Now, the day that you dispose, and that is my last point in the part one. So let's talk about disposal of foreign sub. You see, the day that you dispose that subsidiary, all the cumulative upon disposal of sub, I think somebody can finish my statement for me. Upon disposal of the subsidiary, all the exchange loss, so exchange gain or losses, or let me say exchange differences, all right, that has been accumulated in the OCI. All right, all those ones that have been accumulated in the OCI, i.e. your translated reserve all those ones, all right? So that has been recognized in the OCE, and the one and that of which are in the translated reserve because when you are doing P&L, it's not a translated reserve. It will be in your OCI. And when you are doing a balance sheet, it will be in your translated reserve. All those ones, all right, have become realized. And this thing is also in PPE too, that all these ones being realized. And if it is realized, so IAS 21 requires that upon realization, the difference, these ones are reclassified or recycled, whichever word you want to use, to P&L, all right, or let me say SPL. So if it is balance sheet, then it will be what? It will be recycled to the retained earnings. All right, so ladies and gentlemen, these are the principles that you need to know about foreign consult. We did the part A, did your normal 5 workings. Part B has introduced to you an extra working, which is exchange difference coming from goodwill and also coming from where the opening asset and your profit. And the fact that if the subsidiary is then disposed, all those cumulated exchange differences now will be translated to your SPL or your group retained earnings. So now what I need to do is to pick up a past question. Let's see how we deal with all these things. All right. All right, so this is the question that we have in front of us. Apparently, since November 2019 in the ICAG exam, this foreign consolidation has happened only twice in the paper. So those of you who are writing in 2024 coming and the new syllabus starts in 2024 November, have to prepare one. All right, so we have Bolga Limited is a limited liability company in Ghana, which has investment in a number of companies, other companies. The draft P&L that we have and the other investments are seen, and this is the year, the ending year, April 2020. So you have Bolga, you have Navrongo, and you have Serekunda Limited. Now, you see that the Serekunda is not in Ghana. You see that it is in a different currency from this. So I think this console will be a one that you have 2 subsidiaries, but one of the subsidiary is a foreign one. All right, it's not going to be easy, right? So we have revenue, cost of sales, gross profit, distribution, admin, operating profit, investment income, finance costs, and everything we have here. And it is as at April 2020. Now we go on to the additional information. Since we don't have balance sheet, then probably will be preparing only P&L then. All right, we'll be doing the P&L. All right, so that is that. The additional information says Bolga purchased 80% of Navrongo Limited, 3 million. All right, 5 Ghana cedi ordinary shares for 12 million 2 years ago. And we are also told that at that acquisition date, the current amount of Navrongo's net asset was 10 million. All right, so that's fine. Then we go on to know that the NCI is measured using proportionate. Okay, so the proportionate is where everything goes to the parent, right? So goodwill on acquisition is not impaired. Then we have on October 2019, Bolga Limited sold 1,440,000 of its shares to Navrongo. All right, for 13. Okay, so we are coming to have some kind of interesting thing to be dealing with here, because what I see here is that Bolga as it stands. So this is Bolga, and Bolga disposed. So there is disposal. All right, so that is that. So everything we learned in disposal will also bring to bear. Okay, because Bolga sold 1,440,000 of its shares in Navrongo for 30 million. So Remember disposal. You see it's here. And it says that the fair value of interest retained is 9 million. You remember, I mean, this thing should be coming up, all right? So it says that the retained earnings of Navrongo Limited was 5 million as at this date, all right, 2019, perhaps the opening, right? The opening year, we will check. The only entry posted in the Bolga Limited, the only entry posted in Bolga Limited's individual financial account, so the 13 million received. Don't forget, apart from that, the profit, the gain or loss, all right, has to also be done. And depending on the year in which you are, it can give rise to an increase in tax. The debit to the bank account, this was debited to the bank account, and the credit posted to suspense. Like I always say, in accounting, there's nothing like suspense. All right, on May 2019, Bolga acquired 60% of Serekunda, so that makes it 80 and 60, so that is 2 subsidiaries. All right, 1 million GMD1 ordinary shares for 284 million. Serekunda is a Gambian-based company with the Gambian Delasi, that's the currency, as its currency. So the NCI at acquisition was valued at 116 Delasi, all right, million, using the fair value method. So the other one was proportionate method. This one is fair value method. At May 2019, the carrying amount of Serekunda's limited net assets was 240 million. So this is the date of the acquisition. All right, so don't forget that. But the fair value was 280 million. The excess in the fair value was due to a brand with a remaining useful life of 5 years. So that is kind of a fair value adjustment that we need to do. All right. Then it says that on April 2020, 30th April 2020, it was determined that the goodwill arising from the purchase of Serekunda was impaired by 16 million. All right, so that is that goodwill impairment is charged to administrative expenses. On 28 February 2020, Navrongo paid a dividend of 2 million to 8 ordinary shares. So it means that how much do we own in Navrongo? 80%. So it means 80% of the 2 million might have come to what is the parent name? Bolga, and that needs to be dealt away with. All right, it's intra-group. All right, so on June 2019, Bolga started the construction of a new building and finances through a general borrowing. General borrowing, that brings to mind IAS 23, borrowing cost. The construction was completed on 30th April 2020 at a total cost of 20 million, excluding the interest on borrowing. Okay. Bolga Limited has had the following loans outstanding during the year. So probably where he got the money from. So this is borrowing cost, and it is a general borrowing. So we will see what we will do applying borrowing cost, because borrowing cost is actually supposed to be part of the cost of the asset so that it can aid the depreciation. All right. So basically that is that. Okay, so let's see. All interest has been expended in the P&L. Do you have to expend all interest in the P&L? The part that concerns the building should be part of the cost of the building, not P&L. None of the loan notes are held by any other company within Bolga. So it says that on November 2019, Bolga granted 20,000 shares of each of 100, each of 800 managers. So this one too is IFRS what? 2, right? Share-based payment. The options will vest in 2021 if the managers are still employed. However, 5 of the managers left the company by 30th April 2020, and it is expected that another 5 will leave. All right, so you see where IFRS 2 has appeared. The fair value of the shares were on the grant date, which is the November 2019, was 3.1 and 10 on the ending. You know which one to use. If it is share options, you know which one to use, fair value at grant date. All right, there have not been any accounting entry in these relations, and we have the following exchange rates that has been given to us. So these are the exchange rates. All right. This one to be another question. So that's the second question. So this question looks at P&L. My guess is the second question looks at balance sheet. So let's see how we go around with this. And this is a P&L. So group retained earnings, workings, and all those things, we will chalk it small because this is P&L. And in a P&L, we do our workings 1, don't we? So workings 1. Workings 1, I always tell people, is compulsory. So the group structure, I need to change the board. So let me change the board, okay, because it will slow us down. So let's do our workings 1, group structure. So I think we have Burger, right? And let's go and see from the first note. So I'm going to solve the note one by one, use the note one by one, then we will draw the P&L, right? So Burger purchased Navrongo, and we are told that he purchased 80%. All right, and the date of purchase, what was the date of purchase? This is where it starts from. The date of purchase, where are you? Burger purchase, the date of at the acquisition date, the net asset, blah, blah, goodwill on acquisition was not impaired. On 30th October 2019, Burger sold. So it says 2 years ago. Good. So we have it. 2 years ago. He bought it 2 years ago. All right. So that is that. So we understand. This is what we have. But we are told that he also disposed some portions. So we need to understand that he disposed 1,440,000 of his shares. So we need to find out. He bought 3 million. Now, 3 million of the shares is what percentage? Is 80%. So that is what they told us. Now, what is, so let's work something small here. We are told that he disposed. And his disposal, he disposed 1,440,000. So 140,000 shares. But he bought how many shares? He bought 80,000 shares. And that 80,000 was like 3 million, right? So what portion was disposed? So let's calculate. So we have 1,440 over 3,000. That is like 48%. All right. So he disposed 48% of the 80%, which means that at some point he will lose control. That is what will happen. So at some point he will lose control, because what we know is that he purchased 80. At some point he will be at this one minus 0.8 is 32. So at some point you will lose control. So what is our reporting date? So let's find out our reporting date as per the question. April 2020, 30th April 2020. So, and when was the disposal done? So let's find the date the disposal was done. On October 2020. So 2019. So we know that the financial year ends 2020. April 2020, which means it might start in May 2019. So from November, December, then to April, 4 months makes it 6 months. So it means that for as far as this guy is concerned, our consolidation for him will be 6 months. That is that, because after 6 months, he lost control. So you have to be very, very careful in analyzing this. Do you have to do all these things here? Yes, do them here. All right. Then we also know that he acquired another one in Serekunda. So let's do Serekunda. Serekunda. All right. And we are told that this one was bought on May 1. So that is the beginning, 2019, right? And he bought 60%. And we know that this one is 1 year, full year. All right. So that is that. So you have to do all these things down. So this one will help us with our note 1 and our note 2. All right. And in this question, you realize that we don't have stated capital to do our stuff for our workings too, right? We don't really have them. And so he says that at the acquisition date, the carrying amount of the net asset was 10 million. And this was deemed to be the same as their fair value. So if we were to do our workings too, all right, if we were to do our workings too, they have given us, so we would have done for the two, right? Fair value of net assets for these two people. Fair value of net assets of SAP. And please don't forget, we have to put 3 zeros at the top. Yes, we have to. Everything is in 0 zeros. All right. And GMD 0 zeros. So we have to do fair value of net asset of SAP. And which SAP is this? You have to say Navrongo. And when we finish, we have to do same for, so normally what do we do at acquisition, at reporting, then post acquisition. Please, because of this, you need to show the currencies. Since it's in Navrongo, we need to show the currencies here. Because if you are doing for Serekunda, currencies too become very, very important. All right, so that is that. So normally you start with your stated capital and everything. But the question told us that we've been given the values of the net assets, right, at acquisition, but there was a brand something to deal with, right? So that is that. It says that at the date of acquisition, the carrying amount of Navrongo's net assets were 10 million. So it means that at the date of acquisition, we are told that this one is 10 million. And it is deemed to be equal to the fair value. So there is no fair value adjustment. So that is that. The NCI interest was measured proportionate. Goodwill on acquisition is not impaired. And on this date, there was a sale. Now, you know how we do a sale. So we will do that, where you have to take away the goodwill, where you have to take away the, what do we call it? The net asset, where you have to take away the NCI too. We will go through and do all those things. All right. It's very, very important. Very important. All right. So that is that. And our reporting date is what do we call it? 30th, 2020. It says that the retained earnings of Navrongo was 5 million at this date. So that is the retained earnings on acquisition. So normally we would have done stated capital, wouldn't we? Put the figures here. Then we will need retained earnings, wouldn't we? But so it tells you that they sold, but it says that the retained earnings at this date, that is the opening retained earnings. All right, the opening retained earnings, not the acquisition retained earnings, opening retained earnings. The only entry it has been done in the individual books of account for this. But good for you, you have this. All right, you have that. Very important, you have that. Then it says that on May he bought Serekunda. So the next thing will be about Serekunda. And I think it is in Serekunda the brand issue happened, right? Where is that? Okay, so here, there, it is in Serekunda the brand issue happened. So when we are doing that thing for Serekunda, we will consider that. All right. So basically, that is that. So normally you would have done this, but you don't have all the information to do this. But it's just that you have the acquisition, and I have put it down for you nicely because we know what we will do about that in the post-acquisition sharing. All right. And this one, they sold to lose control. So don't forget that. All right. So we try and fish out what we will also do for Serekunda. So normally it would have still been in our working. So I'm giving you this template because it would have sound like if you are doing a balance sheet, what you would do. So fair value of net assets of Serekunda. And I told you that which currency will you be doing it in the subsidiaries, GMD. All right. You'll be doing it in that regard. So what did they tell us about that? All right, so he told us that they bought 60% Okay, then the NCI at acquisition is given, all right, using fair value method. And on the day they bought it, the carrying amount of his net assets was 240, but the fair value was 280. So the excess is a brand. So it means that, so at acquisition, also, you have something supposed to be what? 280. Now, in that 280, what you realize that there should be a fair value adjustment, and that fair value adjustment is 40. So you would have done 40. Okay, so don't forget we are doing in thousands. So this one too would have been 40,000. But this brand is supposed to be amortized. All right. So as you can see, it's supposed to be amortized. So this one was a full year. So if you were to do the fair value adjustment amortization, it would have been 40,000 divided by how many years? How many years do we have here? 5. All right. And 40,000 divided by 5 is what? 40,000 divided by 5. That gives me 8. All right. So that gives you an 8. So it gives you 8,000. And this is an amortization. So the remaining would have followed. So if you had a stated capital, if you have retained earnings, all right, it will follow. All right, so basically that is that. And you'll be doing at acquisition at reporting. And this one, you do realize that you would have done something like this. 40, 40 dash, right? Because here would have been post acquisition. Then the 8,000 will also follow. So you have something here. All right. So basically that is what would have happened. So if you have the other information, you push it in. All right. But we will still come back to pick the figures. All right. So that is what you have in there. That is what you have in there. That's it. Okay. So it says that on 30th April, goodwill. So we need to now learn how to do our goodwill. But you do realize that as at the reporting date, for as far as the other one is concerned, Navrongo is concerned, they disposed. They disposed. So we need to dispose. The reason why I did this is that we know that there is a fair value adjustment here that is going to our SPL. All right. So please take note of that. And this question we are doing is an SPL one. All right. So take note of that. So why don't we set up what we need to set up? Then when we fix the issue, we come and bring it in, because as far as reporting is concerned, it is done according to IAS 1. So we have what group? Bulgar group, so that we can be fast. All right. And that is your approach in the exam as well. So console, SPL, and OCI. Please, you should write the full. All right. For the year ended 30th April 2020, right? So that is what we have. And since we are going to be doing some conversions, let me just create the currency, the group currency here. All right. So that is that. So you pick some things of the revenue and things. All right. So the same thing, copy and paste. So you have your revenue. How much do you have? You have 286,000 plus. Don't forget, this guy disposes site 6 months too. So you'll be doing 136,000, 6 over 12, plus our person's own 840. Don't forget, we convert them. 840, we need to convert them. And what rate do we use to convert P&L items? Yes, average rate. All right, so what is the average rate? The average rate here is 9.2. So you are going to be converting. All right. So let's do some simple if more, less divide. I like doing that because sometimes people don't understand how these things are done. So it says that 9.2 GMD is equal to 1 Ghana cedis. Now in that case, what will our 840 be? 840 GMD be? 840 GMD we don't know. So it means that what we will be doing is that we will be doing a division. So this one will be 9.2x is equal to 840. So if I want x, so everything we are going to be doing, we are going to be dividing. So right now, you know that you have to be dividing the figure. So here will be divided by 9.2. All right. So basically that is that. When we read this, there was nothing like intra-group. So we can close it out. All right. But cost of sales too will come. So the same thing. So we know that here we are dealing with the 9.2. All right. So cost of sales, what do you have? 122,000 plus into bracket 84,000 6 over 12 plus, so let me do two brackets here, plus 504,000 divided by 9.2. The only thing that would have come here, all right, is probably the adjustment on goodwill impairment and also the brand amortization. But you see, normally these things are meant to be in administrative expenses. All right, administrative expenses, unless the question tells you to put it in goodwill. Impairment and other things, all impairments are supposed to, and amortization of intangibles are all supposed to be part of your administrative expenses. All right, so please, the question didn't tell us where to put it. And so I think the goodwill, we were told the impairment is admin, but it was silence on the brand. So brand, you know, will go to administrative. So it means we can close out these two figures, punch our calculators to get the figures. All right. So, and you have to be fast. So this one is giving me 445,300. All right. So basically that is that. Because, and you have to always start from here. All right. So 840, you should punch your 840 like that. 840,000 divided by 9.2, you have it. All right. It gives you some decimals. So then you do the half of 136, or you can punch it straight away on your calculator and it gives you the thing, but be careful. So open a bracket, do 286,000, all right, then plus, so plus another bracket, so you close that 286,000, or plus another bracket 136,000 divided by 2. All right, and you have to be fast with that, plus another bracket open 840,000, and you are dividing that one by 9.2. So that is what you do. And when you do that, like I had, it's 445,304. But I've just, okay, so instead of rounding it, let me just put the 4. Okay, so 304.34. So let me do it 304. So this is what I have. The same thing I will do for the cost of sales. So 122, all right, 1,000 plus bracket open 504, oh no, 84, 123 divided by 2, bracket close, plus the next one is a bracket open 504,000 divided by 9.2. So that is that. And that one will give me 218,000. So that is that 218,784.83. All right, so that is that. So if you, that is what you need to do for all these things. Okay, so try and do that. So you do that for all of them. All of them. All right. So per what I have, we will put in 218,783 rounded. Okay, so that is that. Straight away, I can get my gross profit, can't I? So minus 445,304. So I have 226,521. And that is my gross profit. All right. So we now come to the others. So the others, we have distribution here. So let me shift distribution. Distribution is 164, no, 20. 20K plus into bracket 6/12 of 12,000 plus into bracket 56,000 divided by 9.2. All right, so that is that. Then we have the admin where the other things will come in. So we have to chalk on that. But first of all, we have 46,000 plus 6/12 of 20,000, bracket close, plus another bracket. All right, here is 116,000 divided by 9.2. Let me wait because I'll be doing other stuff. So already we found out that there is a brand. So the brand was 8, right? 8,000 GMD. And that one too will be at 9.2. All right. Then we need to now do the impairment side of the goodwill. So I will go back and do the impairment side. Or did they give us the impairment value so that I just do it straight away? Were we given the impairment value? Where are you? Yeah, the impairment value was given. It was given here. So straight away we were given, it says that goodwill is impaired. So as goodwill is impaired, we need to also impair that goodwill. So that goodwill is, where are you? On April, it is deemed that the goodwill arising has been impaired. Okay, so if goodwill has been impaired, we will treat the goodwill impairment as part of expenses. But hold on, we always do that thing for where we get the exchange gain or loss issues, all right, to also deal with. Okay, so we must consider that goodwill impairment inside over there. All right, so we will do that. We also do that. All right, so this one is 16 GMD. And the goodwill is supposed to be charged to administrative expenses. So 16 GMD. Let's do 16 GMD. Converting that into CDs will be converting that into a CD will be 1.7. So please, because of space, I'm bringing it down here. So we had 16 divided by 9.2. So that one too is there. All right. So we will do that and we will add, all right, to that. Anyway, so basically that is that. If there is any other thing we encounter, we will bring it. So let's hold on to the admin. All right. After admin, what do you have? What do we have? We will close it out to get our what do we call it, operating profit, right? So we will close that one out. But let's wait. If there is any other thing we need to do to the admin, we will do. But I think that we can do for the distribution because nothing affected distribution. So we have 20,000 plus into bracket 6/12. All right. So that is half. Let me punch into half. 12,000. So half is 6,000. So that is half. So 6,000 plus 6,000. Sometimes you just need to go ahead with some of them. So 5,000, 56,000 divided by 9.2. Then you close that bracket. All right, that is giving me some 32,806. All right, 32,806. So let's put it there. 32,806.9. So let me make it 32,807. All right. Okay. So basically that is that. And after this, we know we get operating profit. Operating profit. Then after operating profit is investment income. Is that not it? So we have investment income. So the investment income, there is a part of a dividend that they paid, and we need to deal with that dividend. We will have to take away that dividend, all right? So the dividend, 80% of the dividend that was paid, because they own 80%. So investment income, we have 2,000 plus, what do we have? 2,000 plus 6/12 of 4,000. So you just have to show it, but we all know that 6/12 of 4,000 is also 2,000. Then this one has 0, nothing. But there was a dividend that was paid, and we need to talk about that dividend. This one, it is between Navrongo, and he owned 80% of that. So 80% of this 2 million has to be done, and that one has to be taken out, all right? Because when you do 0.8 of 2 is 1.6. That is what I have. 0.8 of the 2, so of 2 million. So let me point to 2,000, and that is 1,006. All right. So that 1,006, we all know that this Navrongo guy was there for how many years? They were there, but we were told on 28th. So look at the date. Were they together when the 28th February 2020? Were they together when the dividend was issued? Because we were told that he sold his shares in Navrongo somewhere here. He sold this thing on October 2019. So that should ring a bell, because Navrongo issued our dividend in 2020. By the time she issued out, they did the 2020, this guy was not owning 80%. So we should be careful. So at that time, per our group structure, how much do you think he had? Where is our group structure? So these are the tricks the examiner put in the question. I think he had only 32%. He had 32%. All right, so take note of. So we do know that at that time he had that 32, right? And so therefore it is an dividend received from an associate, and dividend received from an associate, we have to take it out. It's not taken out of the consolidated SPL, because that thing rather reduces the investment in the associate. So normally you debit cash, then it goes to the associate. All right. But in the individual parent account, that is dividend received. But here we were told it was February 2020. At that time, he had only 32%. So let's do the 32% of that money. And we are subtracting. It's our investment dividend from an associate. So we do 32% of the 2 million. So we will write 2,000. And it is in Navrongo, so the currency is not a problem. All right, so that is how we take care of that dividend. So if I do 2,000 plus another 2,000 minus into bracket 0.32 multiplied by another 2,000, I have here 3,360. So that is what I'm going to do with 3,360. So that is how you deal with the investment. So here is 3,360. So you have to be very careful. You see how tricky that thing can be. Then what else do we have? We have investment income, after that finance cost. This is where you have to be very, very careful, because finance cost embodies many things. So here inside the finance cost, what do we have? We have finance cost of 4,000 plus 6/12 of 8,000. Then we have another one that is coming from, 12 over 9.2. All right, so basically, that is that. But we need to hold on small because we have some exchanges to deal with. Okay, that one won't come to finance cost, but however, we saw a borrowing cost issue. We need to find out what we need to deal with that. Okay, so basically, let's go and work on the others. Then we bring it in. All right. So, okay, this is share-based payment. And in share-based payment, what do you find? We have expense, the one going to the expense, and we also have the one going to the balance sheet. So it's another thing that we do. The one that is coming to the balance, the SPL is like kind of the like an unwinding sort of thing. Yeah, so we need to wait and deal with all the notes so that we will know what we will do with our finance cost. All right. Then after that, after finance cost, remember there was a disposal. So definitely you have a gain or loss on disposal, and that thing is supposed to be an exceptional item. So we will come back and slot that one in. All right. So basically that is that. Okay. So the borrowing cost thing is also a finance cost stuff. We will treat it under finance cost if need be. All right. So basically that is that. Okay. So, and this is P&L. We may also get exchange gain or loss on translation, but that exchange gain or loss on translation, we are told that we should be putting it inside the OCI. All right. So basically, that is that. So let's go and do the other stuff and see what we can do. All right. So let's pick the notes one by one as we were doing, then continue with it. When we get it, we come and slot it. When we get it, we come and slot it. All right, that would be the best approach to finish your exam very early. So where were we? All right. So we would have found goodwill, but we don't need to, because normally you find goodwill when you are doing balance sheet. And the only thing that goes to the PML is the goodwill impairment. And I mean, it has been done. So from workings 3, we get goodwill impairment. So there's no need for you to do the goodwill. We are not doing balance sheet. So the impairment has been done. All right. So that is that. Okay. So mostly what will happen is the workings 4, which is your NCI, right? So NCI, but here we are talking about the NCI share, not the NCI that is going to the balance sheet. All right. But again, we also would have done group retained earnings, but group retained earnings is the P&L that we are doing. So that one too is off. All right. So we will use the NCI to do the NCI sharing of the profit that we normally do. All right. But because I always tell you that if there is control to control, you will do it before your workings 4. If there is disposal to as well, you need to do the gain on loss on disposal, that thing that we learned. All right. So basically that is that. So let's do gain or loss on disposal. And you remember how we used to do it? You need the proceeds, right? And in this one, how much is the proceeds? They sold it for 13 million. So since we are doing everything in 3 zeros, let's write 13 million. He didn't sell everything. So what is the fair value of the part retained? So fair value of interest retained. This is the group, all right, interest retained. They probably should tell us how much that one will be. So his question said that the fair value of the retained interest is 19 million. So we have 19 million. So together, that gives me 2, 3, 32. Then we less interest disposed. So what we learned has come in here. So what do? We do the net asset first, right? The net asset at disposal. And how do we find the net asset at disposal? We find the net asset at disposal. Yeah. So in those examples that we were doing, we were giving, and we did an example where we were not giving. All right. And how did we come about that? We came about that by doing the net asset at acquisition, right? And we also had to do the share, all right? So that one too, we had to do it. So the same thing we learned in the what we call changes in group structure, the same thing is going to apply over here. So they will share profit. The profit that they will share is coming from this is our profit. And since this disposal is happening within 6 months, this is where you will share the profit. So please bear in mind that it's very, very important. Then we need the retained the retained earnings, which is at reporting, becoming that one at disposal. So how do we find those ones? So let's go and see how we come about those ones, because they need to give us some information about those retained earnings that you see. All right. So we need to find that. So normally you do your what we'd have done in our workings too, right? So you will need share capital. All right. So this is where I will take you back to the top, and we will need the retained earnings. All right. So if we were to do our workings too, it would have been easier, because they were told that the capital they bought 3 million shares, and it was priced at 5. So 3 million priced at 5 gives me like something like 15,000 with our 3 zeros. All right, and we were given the opening retained earnings. So this is coming from last year, and we have the part of this year. So this one, so retained earnings at reporting. So if we were to we were to do Navrongo had he bought 80 millions of Navrongo's 3 million shares. So it means Navrongo already had 3 million shares. So if we were supposed, like, I didn't want to do the workings too, but if you see this, you see that Navrongo had 15,000. So this is how it would have been. But you see, we were giving something like this already. That's the danger. Now, because you were told that he had 3 million shares, so, and it was priced at 5. And the retained earnings, we know that the retained earnings they've done up to this point, that is not really retained earnings at acquisition, because we were not giving the retained earnings at acquisition. But we know that the retained earnings as reporting, since they are selling, it will be 6 months of this and the opening balance of the retained earnings. That's why I'm doing everything inside over here, because those parts becomes relevant. So we were giving retained earnings, opening retained earnings for this guy as at is 5 million. So opening retained earnings is 5 million. So let's write 5,000. All right. Plus, to the time they sold, we have 6/12 of the figure, of the figure that they have here, 12,000. You need to find these things yourself. That gives you the retained earnings that he can have. So this one will give me 6, this one will give me 5. That makes it 11,000. So this is the net asset. All right. So what did we normally do? Let me push these figures here. All right, let me push them. Then you get, this one is 26,000. Then we come and take goodwill 2 out. Net asset, please, this is supposed to be net assets at disposal. Then we come and take goodwill at disposal. But before we can get goodwill at disposal, we need to get goodwill at acquisition. So what was the purchase consideration when they did this one? So we are told that they bought it for 12 million. So purchase consideration is 12 million, so 12, 3 zeros. Then NCI at acquisition. We could have done that in our workings 3 for both of them. All right, and pick the figures, straightforward. But I mean, this one, our concept is to look for the impairment when you are doing that, because we are doing P&L only. All right, you could have done that if you wanted to. So the what do we call it? The NCI at acquisition, well, at the date they bought the thing, This is the fair value of net asset, the one we will less. Net asset at acquisition was given to be 10,000 or 10 million. And we need the NCI at acquisition. So what did they tell us about the NCI of this company at acquisition? So we are told that, where are you? Do we have you? When they bought Nabrungo, this is the information we have. They bought 12 million. Acquisition. Net asset, blah, 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 is deemed to be as their fair value. The NCI use proportionate. So if it is proportionate, then it means we are going to do 20% as at the time. We are going to do that percentage of this same value. So proportionate. So it's 20% of the 10,000. So 20% of this one is like 2,000, right? All right, so that is how we get our goodwill. There was no impairment in this question for this particular goodwill. So 14 minus 10 will be 14,000. So I have done that too. Then what do we have for the other side? We will less what? NCI at disposal. I think that one we have a fair idea of what that thing is, because we know that NCI at acquisition, we can fish it. All right. We have it here. And the other one too is here. So NCI is 2,000. Okay, so we have that 2,000. Then what do you do? NCI share. All right, so you need to do the NCI share of post acquisition, whatever the share. And please, it is within. Everything is within. So NCI share of post acquisition. If we had done our working, so we would have found certain things. So NCI share of post acquisition. So up to the point that they did the disposal. All right. So like I always tell you, you have this one. So we know at acquisition minus at reporting, or at reporting minus at acquisition, you get the post acquisition. So we have all of them here. So NCI of post up. The NCI at reporting, which is at the time the net asset at reporting, which is at the time they dispose of this thing, is 26,000. So you don't struggle. Minus the fair value of the net asset. That one too is this one. So fair value of net asset. That one too is 10,000. Then you strike your 30. What percentage was that? 20%. 20% of that. All right. So let's do that. Yeah, that's the NCI. So you are left with 6,000. So 0.2 by 6,000. That is like 1,002, right? That is 1,002. Okay. Because 26 minus 10,000 is 16. Sorry. 16,000 multiplied by 0.2. Sorry about that. That is 3,200. All right. So I have that. So 3,200, we put it together. Oh, we are going to less everything. We put it together. We have something like 5,200, which we are lessing from this. And we will less again from that. This thing is from the previous video. So let's do 26,000 plus 14,000 minus 5,200. And that gives me 30. That gives me 34,800, right? Oh, this thing is also a mistake. Look at this. Forgive me for putting wrong figures there. The mind is going faster than the hand. Or the hand is going rather faster than the brain. Because I know that if you take this one, it's supposed to be 4,000, not 14,000, right? All right. So it should be, I should take like 1,000 out, 10,000 out. So let's put 26,000 plus 4,000 minus 5,200. That is 24,800. All right, so that is what we are lessing. So to get our gain or loss, what do we have up there? 32,000. So minus 32,000. So if I do minus 32,000, right? And I'm having 7,200. So that 7,200 is actually a gain or loss on disposal. And what did we say we do to this? This one, we present it as an exceptional item in our P&L. So let's go and do that exceptional item inside our P&L. All right. So where is our P&L? Gain on disposal, exceptional item on our P&L. So that is 7,200. So we bring that one in here. 7,200. All right, so that is sorted out. All right, the other things we need to sort out will also be the IFRS 2 staff, the share-based payment, the borrowing cost staff. All right, so we deal with those ones and probably we are good to go. All right. Now, you see, it would have been nice if you would have done the goodwill for our workings 3, and you can refer the examiner to this, all right, and put it here. But it's good you also show the workings, because there is even goodwill to even do for the other guy, the Serekunda, all right. You may have to do goodwill for Serekunda or the goodwill translations thing that we deal with over there. So now, let's go back and deal with the borrowing cost staff and also the share-based payment staff, because we've basically worked on our workings 3, workings 2, and this one is the next one, this workings 4. All right. So what do we have to see about that? We are told that they use general borrowing. All right. So they started the construction of the project, used general borrowing, and this general borrowing. What did you learn in IAS 23? We said that we need to find the rate, the capitalization rate, all right? And per the capitalization rate, what are we going to do? We are going to do 10% multiplied by 28,000 over, what is the addition of this? 40,000 plus 8% multiplied by 12,000 over 40,000. So we are finding the capitalization rate. All right. So how much would that be? So if I do 10.1 multiplied by 28,000 divided by 40,000, that gives me 0.07 plus we have 0.08 multiplying 12 over 40, and that gives me 0.024. If I add it plus 0.07, I have the capitalization rate to be 0.094, basically 9.4%. Now, once I have my general rate of 9.4%, and I need to multiply it by the fund that has been borrowed, all right? So we know that the fund that has been borrowed here is 20 million. But when was it borrowed? We said that the capitalization commenced June 19. June 19 to April 30th, 2020. How many months is that? So June, July, these things are very tricky. So June, July, August, September, October, November, December, that is 7. January, February, March, that is 10. Then the April, making 11 months. So it means you need to do 9.4 multiplied by 11 months multiplied by 20 million. That is the part that should be borrowing costs. All right. So then we have the extra 1 month going to be part of our normal expense of finance cost. So that is what we need to do. All right. So how much would this one be? So this 0.4 multiplied by 11 over 12 multiplied by 20 million. And what I'm having here is 1723.33. That is what I have in here. And what is the impact of this? All right. So the question went on to say that the construction was completed exactly the time, and we did that. So it was 20 million. All interest has been expensed in the P&L. None of the loan notes are held by any other company within Bulgar. So all interest expense. So it tells you that what they did was to use 9.4 by 20 million. That is basically what they did. So 0.094 by 20. And that is actually 18880. Now, if they put all these things there, this one should be out. This one should be out. So what is the difference? So 1723. So let me put the rounding away. Okay, 23, because that is what we've been doing. So the difference is like 157. So apparently only 157 is supposed to be in the SPL. So it says that all the interest has been expensed in the NCL. It means we need to take this one out of our finance cost. All right. And keep the 157. So that is what is going to happen. All right. So let's go and do that. Let's go and do that. So, oh, sorry. Where is our P&L? That's why it was advisable not to actually close the finance cost, because this thing is about Bulgar. All right. So it was really advisable not to actually close the finance cost. So, hey, it's 17. How much was that? 1723 is what we need to deal away with. All right. So if everything was put in our finance cost, then let's go and take away the 1723. What is our finance cost? So after we close this, minus 1723. It's already in cedis. So we need to take that thing out. All right. And the borrowing cost, we know that once we do that, only the expense part will be there. The borrowing cost is actually supposed to be part of the cost of the asset. So that is what we have done. It shouldn't be part of the P&L activities. All right. So that 17 should rather go to PP. Okay, so it should rather go to PP. All right. So basically that is that. Let's take it out, and I think we can get our finance costs. So we go to the next note, which is also about IFRS 2. Let's deal with the IFRS 2. Let's open the workings for IFRS 2. See, this thing is very cumbersome. So my advice to you is that draft your P&L, tackle the notes one by one, and push the thing in. When it is P&L, it's very, very confusing. And the thing is that it doesn't balance for you to know that you are right or wrong, right? So we are told that they granted 200 options, all right, for 100. So in 2019, November 2019. November 2019 means 6 months, right? So we have November, December, then the 4 months. So it's 6 months. So be very, very careful about that. And how many years are they doing this thing for? Up to 2021. So that is like 2 years. So we are doing just 6 months out of the 2 years. So we have 100 people. All right. This is the year we are concerned with. And they told us that, however, 5 have left by 20. So we know that 5 have left as at the time we are doing this. And they told us that it is expected that 5 will leave again. So you remember what we do. All right, so this is what will happen. Then which fair value are we going to use? Fair value at grant date, 3.1. And it is how many number of share options? 20,000 share options, and multiply by timing, 6 out of the 24 months. So normally you do expense and you do what? Your OCE. So how much do we have? So this will be 90, right? 90 multiplied by 3.1 by 20. That is 5,588, then multiply by 6 over 24. So that gives me 1395. So 1395, 1395. We are not doing balance sheet. So this one too should go into our expense. And which part of our expense? All right, let's slash it as part of the finance cost things over there. All right, let's slash it there. So this have no entry has been done at all. So it's either you add it to the fund. Okay, this is actually not a borrowing, it's about share-based staff. So staff, let's add it to our administration. All right, it's about staff concept. All right, that is what we do in IFRS 2. So how much was that? Who did that? It's in Borga. So plus 1395. It is in our correct currency. I think we can close that one now. So we are gearing towards completion, right? But it's cumbersome. We have 46,000 plus into bracket 6 over 12 of how much was that? Is it 20,000 or 200,000? My own writing is giving me up. So 20,000, that would be 10,000. All right, plus we have 116,000. So brackets 116,000, 1, 2, 3, divided by 9.2, bracket close. All right, plus again, right? Plus another 8,000 divided by 9.2, right? Then there is another 6. What 6 is that? 1 6. Which one is that? The impairment, right? So it was 16. So let's make it 16,000. So plus into bracket 16,000 divided by 9.2 again, then plus 1395. So that is what I have here, which is giving me 72,612, 72,612 is 0.39. So let's leave it like that. So this is what I have. So now that I have this, what do I need to do? Find my operating profit. Is that not it? Let's find our operating profit. So this one plus 3208, is it 081 or 087? My goodness. Yeah. I should remember this. I think it's 1. So let's keep it at 1. 081. Yeah, I remember. 081. So I add it together and I take it out of 226,521. And so I have 121,808 to 7.6 or 828. All right, so that is that. And I already have an investment income. So the last thing that I need to take care of will now be the finance cost that we are doing. So we've done the finance cost aspect too. All right. So we need to do the exchange gain stuff. All right. And now bring them in. And I think that we will be good to go. All right. So let's do the exchange gain things. So we had goodwill and goodwill impairment from that guy, but we need to do the whole goodwill, because if we don't do, we can't do the, what do we call it, the exchange gain or loss. We won't have our opening goodwill, we won't have our closing goodwill. So we need to do that just to fish out. So we are going to do that one, and we will also do the opening net asset too. All right, then I think we are good to go. So let's do those two. Okay. So what is the goodwill? And normally, please, I skip these things. Normally, these things are done in your workings 2, workings 3. So I skipped it because the impairment was given to us. Unfortunately, we still have to do it. All right. So the goodwill for the foreign guy. So Serekunda. All right. What is his goodwill? We need his purchase consideration. We need the NCI at acquisition. We need the fair value, less fair value of net assets at acquisition. And that one, there was impairment, so we will need his impairment. And we will get goodwill at acquisition. So how much was his purchase consideration? Where are you? Serekunda. Serekunda, we have it here as 1 million. They bought it for 284. The last 284. Yeah. Then what is the NCI at acquisition? When they bought it, the non-controlling interests were valued at 106. So 116. All right. So that gives our total here to be like 400,000. Then NCI at acquisition. Where are you? Oh, we've done the fair value of net asset at acquisition. So the carrying amount of Serekunda's net asset was 240, but the fair value was 280. Which one do you use? We use fair values. So don't get confused about that at all. So what is our goodwill at reporting? That will be 120,000. And we were given impairments to be how much? 16, right? If I take 16 out of this, 16 of 120 will be like 104. So this is goodwill at what? Reporting. So basis this, we are going to do our translation working. So the 2 translation working. So goodwill translation. So we have opening goodwill. And please, what we mean by opening goodwill is goodwill at acquisition. So we are doing it in GMD. We will put exchange rates here, and we should get it in cedis. Don't forget, everything we are doing is in 3 zeros. All right, so the goodwill we have here was 120,000. All right, now, which exchange rate do we use? Average rate, opening rate, closing rate? We use opening rate. All right, so that is that. So opening rate or spot rate, right? So I told you that if the guy is bought, so opening rate, this is the opening rate, this is the closing rate, and this is the average rate. All right, and I told you that if the guy is bought, we use what? The date the guy was bought. So that one will be, all right, so spot rate, the date the guy was bought. If the goodwill is carried forward from somewhere else without the date, then since you don't know the date, you'll be using what do we call it? It should be the opening, and your opening will be the opening date of the balance sheet figures. All right, so this one, are we dividing or we are multiplying? Well, if I think everything we have been doing is division, right? So we did that and it was division. So you have 120,000 divided by 10, that gives you 12,000. All right, then what else do you bring? Impairment. But what rate do we use for the impairment? Impairment is P&L item. So impairment is 16,000 and impairment is P&L item. So we use average rate. So I think we have done it already where we have the 16,000 divided by 9.2. And that is 1739. All right. 1739. There is a point, but it's 0.1. Then we have goodwill at end. So the goodwill at end is 104,000. We convert that using closing rate. That is 8. So 104,000 at 8 gives me 13,000. So there will be a difference. 13,000. So if I had 12,000 and I'm taking away 1739 and the difference goes to 13,000, I have 2739 to be exchange gain or loss. In this case, is it gain or is a loss? It's actually a gain. So it's what? 2739. All right. So that is what I have. Okay. So basically that is that. We know how we are going to do this. Were we told here it was a fair value method that was used for Serekunda, right? But the other one was proportionate. This one was fair value. So fair value means that this figure, you need to share it. So how much you go to the CI, multiply by CI is 0.6. Imagine you are giving these exams and it is in a mixed group where the guy bought, so this one is 4.3, where the guy bought like D shape. You see how complex these things can be. So if I take it now from my 2739, my balance is 1097 or 96. It's 95, so but it has to be 9. Let me check the first one. It couldn't be rounded. It was 4.3. So this one should be rounded to, but I have 9.6. All right. Yeah, because the balance is 9. All right. All right. So basically that is that we share it. And this thing that you have shared, don't forget, if you were doing balance sheet, that is what you have done. But we are interested in this figure. All right. So if you are sharing your OCI, we said that this thing is going to OCI. All right. So it has helped you to share some of the things to your OCI. All right. What about the foreign one, the opening net assets? So we do say, so I'm going to repeat. So we have opening net assets. We are still in the foreign, opening net assets. And in this guy, his opening net asset was 280, fair value of net asset at acquisition. And we here will be 10 again. So 280 divided by 10 should be 28,000, right? What else do you bring? Profit. All right. So profit. So we do profit for the year. So now the profit or loss for the year, how much did they get in the profit or loss for the year? They had 116 profits. But don't forget that the 116, it is these same people who are the brand, all right, which we had to deduct from. So it will be 116,000. The brand, we had 8,000, right? So you need to less your 8,000 from it because they didn't do it. We need to do it. So 116,000 minus our 8,000 brand amortization gives me 108. You need to be careful with these things. And this one too, you need to, convert it. So let's go and see our conversion rate is 9.2. All right, this is profit, 9.2. So if I divide this thing by 9.2, what I have here is 11,739. 11,739. There is a point, but when you round, then what is the fair value of net assets at, the end of the period, which we will change using the 8. All right. So how do we find that? We just have to add this thing together. We have 3, 8, 8. So if I have 388 divided by closing rate of 8, that gives me 48,500. Don't forget this thing that we have done, we need to just do the addition and find out the exchange difference. All right, so let's do that. So 28 plus 11,739, it gives me 39 something, 39, and then minus 48,500. That gives me 8761. 8761. So that is that. Okay. So here too, the same thing. This is what we've had, and we are going to share it. All right. So the attribution too will happen. So it is 60 and 40. So if I do multiply by 0.6 for the CI, I get here. It doesn't matter the method that is used for 5257. So if I do that and I take it away from 8761, I have NCI. So these are the things that you'll be sharing in your OCI. 3504. All right. So basically, that is that. All right. So we are good to go. Everything has been done. So these ones will go into your OCI. So let's just go and close out everything that we have done in the P&L, and we can call it a day. All right. Where are you? Okay. So here we are. All right. Just making sure we've done everything one more time. This is done. This is done. All right. Okay. This one too, dealt with it. So that is it. I think that's the only thing. So let's just put in the figures. And we know our OCI items too. So we were left with finance cost to close out, right? So that one we have 4,000 plus half of 8,000. Is it 8,000? Let me check again here, please. 8,000. So half of that is also 4,000 plus into brackets 12,000 divided by 9.2 bracket close minus 1,723. All right. So for my finance cost, what I'm having is 7,581. So that is finance cost. So everything is done. Let's close out. We just do taxation and that. So in all, I have 121,828. Then plus 3,360 minus 7. What was that? 7. Interesting. 7,581, right? then plus 7,200. So I have here like 1, 2, 4, 8, 0, 7. So basically that is that. So the next thing is my tax. All right, my tax. So tax 2 is the same thing. Okay, so let's pick the figures and slots. Oh, this thing is slowing me down. 22,000 plus half of 6/12 of 4,000, then plus 36,000 divided by 9.2. All right, so how much do I have? I have to wait. Okay, good news. It all has dropped. So let's punch this thing in. So if I punch, we have 22 plus, like that would be like 2,000, right? Plus into bracket 36,000 divided by 9.2. And what I have here is 27,913. 27,913. So basically that's it. So I have 96,894. All right. So that is that. So the only thing that probably we might have forgot in here, which I wouldn't want to go back and change the figure, is when the guy became an associate, we should share the profit of the associate into the console. The dividend is taken out, but the share of profit, I think I skipped that. So anytime that somebody becomes an associate, you have to. So what I'm going to do here is try to bring that one inside here. Okay, that is possible. So what is the share of profit? Share of profit as he was an associate. At that point, he became 32%, and the associate profit afterwards is the 6,000, half of that. So let the thing drop so that I will do that. So I know half of that is 6,000, but his associate share was 0.32 we had. So there is a 1920 to be added to what we have done. So this thing is freezing. Let me wait small. So that means that our figures will change small. So this one, we have 124. We need to add everything again. Thank God for technology. Then this figure 2 will change for us. All right, let's go ahead. So now I have what? 121,828 plus 1920 plus 3360 minus 7581 plus 7,200. So when I do that, it's actually 126,727. Then minus 27. What was that before? 27, is it 913? I need to do it again. So this one was 22,000 plus 2,000 plus into bracket 36,000 divided by 9.2. That is 27,913. That is what it was. And so if I take that one, 126,727, and that gives me 98,813. So basically that is that. So it is this one that we will be sharing. But good news, you remember we've shared the NCI portion before when we were doing the disposal. All right, so you just bring that one in and the remaining one will be for. So we have NCI. So the attribution is what I'm talking about. So the NCI, what did we get before? Oh, freezing. Goodness. Yeah, the NCI thing that we did, you remember? So the NCI share, what was it? Oh, we didn't do that. All right. So we had this 5,200 before. NCI share of post acquisition, 5,200. All right. So we had that already. So it is done. If you want to repeat the doing, you have to share this one, half of this one. Okay. Yeah. And the net, uh, these things are two. So let's actually work it. Let's work it because we have this one coming from, who is that? The one that the disposal was done was in Navrongo, but the other person too is there. So there has to be this part too that we need to share. But before we share this, remember there was a brand that we had to take care of. All right, and we need to share that. So we are going to do all those workings and do that. Wow, I have a big challenge with this machine now. Very blinking. Let's do that. Where can we? So just find a place and do that because we have done, you can pick that one and do, but you see, there are two people in there and we are going to share their profit. And this profit, you do 6/12 of that and you share with the 20% because he was 6 months. But this guy too had 116. We had to take brand, and when you take out the brand, then you share it. Then the goodwill impairment too of this guy to you share it. So basically, that is what is going to happen. So if I'm going to do this, I'm going to share the NCI profits. Then, so I'm going to do 20% for Navrongo, all right, multiply by his 12,000 into bracket 6/12 of that. So I'll get it from Navrongo. Then Serekunda, his post acquisition will be, I have 40%, right? Multiplying into bracket 116,000 minus the brand. We need to convert. We do everything and we will convert because this one is in 116. So there was a brand of 8,000 in his currency that we had to deal with. All right. So my machine keeps freezing. I have to wait small. This thing is in GMD, the Lassie. So we will divide everything by 9.2. Okay. Then in the same guy, he has 40% of the impairment. All right. And the 40%, the impairment that happened was 16,000, right? So multiply by impairment of 16,000. The 16,000 also divided by 9/2, 9.2. All right. So basically that is that. So when we do this one, what would we have? We have half of this is 6,000. Half of this is 6,000. Then 0.2 of that 6,000 is 1,002. Then this one we have 116,000 minus the brand issue 108. We've had this before. We just divided by 9/2. And that one too gives me 11,739, which we've had that too before. Then we less impairment. The impairment was, oh, let me do it again because it's 116,000 minus 108,000 minus 8,000, sorry, minus 8,000. I have 108. Then I convert it to 9.2. That is 11, but I need to do 40% of that, so 0.4. So let me cancel this. All right, so it's actually 4,696. So let's work that one. 4, 6, 9, 6. All right. So basically that is that. Then this side too, I had 16,000 divided by 9.2, which gives me 1739. We've had it before. All I'm doing is to multiply by 0.4. So that is a 696. So that's that. So that is all you do. Okay. So everything has been converted. So we have 1,002 plus 4,696 minus 696. It gives me 5,200. So basically that is that. So when you go to your P&L, sharing from the 5,200, the balance that you have will go to the NCI. Then you already shared the exchange gain and losses that also went to the OCI. So that one will just be copy and paste. All right. There is nothing new there. All right. The freezing. So 5,200 we had, right? All right. So NCI is 5,200, which means the balance will go to the CI people, 5,200. All right. You can add your OCI here directly, or you can choose to do what I've done. So 98,813 minus that. It means these people are going to get 93613. Then it balance 98,813. Then you come to your OCI. So the OCI, we shared it. The OCI total to you will bring. Then you will share. I mean, we did that one already. It was coming from the exchange losses. So all I need to do is that we even shared it over there. So copy those sharing and come and paste it. All right. So that's all. Freezing is no help. So where were those things? The exchange gains. The exchange gains, where are you? Yeah, so the exchange gains, there were 2. So you go and put the 2 in the OCI and share, like this one will be added to. So I'm just going to drop it here. So your OCI part of that one will be this total. We have 2739 plus 8761, which gives 11,500. So what you can do is that if you get your profit after tax, you can come and add this 1,228. So you add it when you get total comprehensive income. Then when you are sharing, after you had 5,200 for the NCI, you come and add these 2 figures to it. You see this one, 10, and this one. You add it to it. So your 5,200 will be plus what do we call it? 3504 plus 1096. So it will be 9,600. So once you are sharing, so it would have been like this, because this one is 11,500, right? So you can do that, or you can just finish sharing the first part, then you go and share the second part. That's all. All right. So for example, with this thing that we did, this one that we did, instead of ending it here, we will come and like add the figure of the comprehensive income. Oh, it's freezing then too. So what I'm trying to do, wow. Okay. So let me just try and delete these ones. It doesn't mean when you share the P&L before sharing the OCI, you are wrong. At the end of the day, the total is the same. So this line too must come down. So this one will be out. Because now 5,200 plus, what did we get? 4,600. I'll add it up. So, all right. Okay, so this is what I'm saying. So now, let me clean this one too. So after we get our profit after tax, we know that there is an OCI aspect of what we need to do. Okay, so wait a bit. So let's say I have OCI. So this attribution will not be there. So I have OCI. And the other comprehensive income is 11,000 something, right? 11,500. So 11,500. So then I will add now. Okay, so that is what will happen. So 11,005. I know that we had 5,200 before, and I'm adding 4,600. So let me write it here. So if I add 11,500 plus 98, what 813, that gives me something like 110,313. And also, so the figure that is here is going to be 9,800, right? So 9,800 for the NCI. So minus 9,800, then you know your CI people. Your CI people will be 100,513. So in all, it balances in 110,000. 313. So ladies and gentlemen, this is it. So in a P&L, draft your P&L, write the figures in there. What you need to do, 6/12, do 6/12, do all those things. And to come and do the adjustment and add. All right. So basically that is that. So you see in November 2022, they brought in what do we call it? Disposer. All right. And we also know that since we are doing foreign console, we need to do the extra 2 workings. So that is how everything pans out. So there is another question which I would have loved to do by to prolong the recording. But that one, this is it, May 2021. Why don't you take a look at it and try your hands on it? Anyway, my name is Thomas. You should like the page. You should subscribe to the page. You should share the page. All right. So God bless you. Bye-bye.